Welcome everyone to 5 Oracle EPM tools for thriving in a changing economy. We have more than 200 people that are joining us today, so we are going to give them about another minute to finish getting through all the lines of GoTo or Zoom webinar connection. So we'll be getting started very shortly. Welcome everyone. My name is Edward Roski, and as CEO here at Interroll Consulting, I've been helping companies deal with uncertainty for over 25 years. We are here today to talk about 5 Oracle EPM tools to survive and thrive as the global economy goes on, let's just say, a really fun roller coaster ride. It's difficult to plan when everything is changing. That general concept, that term is called uncertainty planning. And traditional financial planning and forecasting assumes that things are going to keep trending roughly the same, that past performance is the best indicator of future results. Suffice to say, that hasn't been true lately. Uncertainty planning is preparing for what if our organization or our industry, or I don't know, the entire global economy goes in a different direction than we were otherwise expecting. Because in 2020, the only thing we can be certain of is that uncertainty. It is that new normal. So we have a special guest joining us today. He is my good friend. I have known him for, let's just politely say decades. We don't want Matt or I to sound too old. He is my good friend, but he's also a professional raconteur, Senior Vice President of EPM for all of Oracle Corporation. Matt Bradley is here to talk today about how 2020 is the very first time in history anything has actually changed. Right, Matt? Like, I assume the world was static up to this point. Matt, thank you for joining us.
Thanks very much, Ed. Good to be here with everybody. Thanks for giving us the opportunity from Interroll to chat with you today. So as Edward pointed out, I am the Senior Vice President of the EPM development team. But what gives me sort of a unique perspective is that it is a global team. So I've been dealing with customers, across the globe as they all really try to adjust and figure out what is the next steps to actually move forward. So I'll do a little bit of an introduction at the start, and then we'll turn it over to the Interroll team where they can go into the meat of the conversation in terms of the 5 tools that we've identified that can really help. But as Ed pointed out, rather facetiously, change is nothing new. I mean, these events have happened before, and they've been large disruptive events in various different shapes and forms. In my professional life, these are the 5 or 6 that I've seen. And I'm sure, with the rest of my professional life, I'm sure I'll see a few more. I think change is the new constant, not to be too controversial. But if we move to the next screen, we'll see that this one is a little bit different than some of these previous crises that we fundamentally have. I mean, first and foremost, we have to recognize the human element. I hope everybody is being safe. And following the guidance. We're washing our hands, we're wearing our masks, and we're socially distancing. And so I encourage everybody to do that. But what makes this different is fundamentally this high level of uncertainty. As we've seen over the at least here domestically in North America, things were trending well, the curve was flattening, and all of a sudden it changed. And we have a new resurgence, et cetera, from that standpoint that just sparks the level of uncertainty that's coming in through. And the experience here is not that dissimilar from experiences in other areas of the world who've gone through a similar, change. Australia had a great handle on it, but now they're seeing a spark back up through that we're seeing recently. Europe is going through its fundamental changes with Spain now introducing some new lockdowns, et cetera, from that standpoint. So we are seeing this high degree of uncertainty, which then just causes us angst in terms of what do we do and how do we actually address this. The other thing that is somewhat different from some of the prior crises that we've seen is the breadth of it. This is impacting every industry. Ultimately, it did start off in the travel industry, cruise, air travel, hotels, etc. from that standpoint, but then quickly spread into fundamentally every other industry, retail, etc., as we work out through. And as you look at this, there are fundamentally different styles of use cases and different styles of challenges that each industry is, going through. So if you look at oil and gas, they had the double trouble of, the Saudi Arabia, Russia issue and the drop in oil prices that was fairly dramatic that led into this, which then fundamentally leads into how do they fund this? How do they do divestitures? If we look at healthcare, basically due to the lack of elective surgery procedures that's happening here domestically, the revenue is fundamentally dried up from a provider standpoint. And ultimately, we're seeing some changes even on the insurance side in terms of individuals are having to make decisions, and sometimes, paying for healthcare is not something that they can afford at this point in time as the economy shrinks from that standpoint. And as you work through some of the other industries, you'll see there are cyclical, relationships. As retail gets through store closures, that leads to rental defaults on the real estate side. If you were in a REIT or managing a mall, what does that mean? That means mortgage deferment. That fundamentally then impacts potentially, pension plans and various other organizations. So this connected industry and the global nature of this industry is really leading to, an unprecedented shift as to how we move forward. But it's not necessarily all bad news. If we jump to the next slide, there are certain things that we can fundamentally do. And some of this is a little, mom and apple pie, but it's back to the basics in terms of enterprise performance management. We are encouraging our customers to really have a look at how you can be and maintain the collaboration. Now we're all moved to working from home. We need to have connected systems. We need to have that visibility across the line of business. So we understand how we can close our books and how we can make sure everybody's on the same song sheet, so to speak, as we try to move things forward. So it's extremely important to look at how we can maintain that collaboration and make sure we involve the right folks as part of the decision-making process. The next stage that we are definitely a proponent of is this notion of model-driven. And what we really mean by model-driven is the ability to model your business. And once you've got that model in place, you can then turn the crank several times as you run through multiple scenarios. So putting the effort in to put that model in place gives you the ability to be iterative. And as you go to being iterative, you can look at various different scenarios, various different outcomes, and then ultimately make the right decisions in terms of how to really drive things forward. As you mentioned before, connected is extremely important. And when you get into the FP&A arena, it's really looking at the broad holistics. It's no longer just focusing on the P&L. We have to now focus on the balance sheet and focus on the cash flow. We've got to make sure it's connected from those particular standpoints, but we also make sure it's connected, across the broader, wider industry. We really need to have these leading indicators from the operational side of the house that really gives us an indication of what's occurring. Are we seeing an improvement in business? Are we seeing a further decline in the business? So we can become agile and really address how we make our changes to those particular pieces. We fundamentally believe this needs to be data-driven. So you're going to have a good understanding of your data. What is the variable and fixed nature of your cost structures, so that as you make decisions, they actually have the impact you expect to put in place. It's really trying to move away from, while there's a desire to move back to Excel because it's quick and fast, that brings in all of the challenges that we've always known about Excel. It breaks the data, single data of the truth. It adds in a degree of variability, and it can be a quick fix that ends up meaning mistakes are made, bad decisions are taken. I'm really encouraging, let the data really help and stay true to the course in terms of the value propositions that enterprise performance management provides. And obviously the last piece is the agility. By the combination of these other four, we can get that agility in place. We can have a look at things and try to address things as they move forward. We recognize that change is going to be there, and so we're going to have to manage our way through this change in introducing that willingness and that ability to make these changes in business models, in organizational structures, in how we actually advance the business going forward. Now, all of this sounds a bit doom and gloom, but if we jump to the next slide, based on work that we've done with McKinsey, and they've looked back at several other crises that have occurred, there is this differentiation that occurs between those companies that are resilient and those companies that are not as resilient. Those companies who have taken the appropriate steps to manage their way through this exercise versus those who fundamentally did not. And so for the companies who perform well, we do see increases in revenue once the upturn takes in place. We do see this as an opportunity to refine the cost structure and see some efficiencies driven in through because of this. So we do see them, exceeding in terms of reductions in cost and infrastructure. The other area that we do see things is really understanding what needs to be divested, what things are profitable, not profitable. It could be organizations, it could be products, it could be, various different pieces. So we do see an increase in divestiture during the downturn, but that fundamentally leads to that increase in acquisitions as we move into the recovery phase. So the strong typically get stronger, and that's ultimately what we are encouraging organizations to do, encouraging your organization to do, is to become this more resilient piece. And so with that, I'll turn it over to Edward, and he can then talk down through some specific areas where we've seen value in terms of turning on things from an EPM standpoint.
Awesome. Thank you, Matt. If you have any questions over the course of this hour, Matt and I will be available to answer those. We might have some time at the end, although I doubt it because Matt and I tend to talk a while. But we will be able to answer them at least through the Q&A bar. It should be down there at the bottom of your screen. It says Q&A. If you type in your question, send it across. Matt or I or somebody from the Interroll team or Oracle team will be able to get back to you. All of our customers, like Matt is saying, are going through this period of accelerated change. If you look back, believe it or not, we're only halfway through 2020. This is the longest year of my entire life. And it was only March when we were all still traveling and people were thinking, oh, maybe this GDP growth might slow a little bit, but nobody was predicting a recession. And today we are fighting for the survival of our companies. But as we were talking about, we're starting to see signs of that economic recovery. And the companies that are going to thrive over the next 10 years are the ones who see this as an opportunity. And I'll be talking about some of those economic recovery things that are happening towards the end of this presentation. But while everyone is hoping that the economy recovers quickly, there are a few tools companies absolutely must have if they want to make it through any period of economic change, particularly the biggest one we've seen in our lifetimes. So today I'm going to cover what those 5 tools are at a high level. I'm going to give you a brief sample of each one and how you can use it. So we're going to dive into our first tool for surviving change. This is by far, we all agree, the absolute most important tool companies need right now, and that is scenario planning. During times of massive upheaval, the finance department goes from being, if we're being polite, a support department, if we're being mean, overhead. They go from being that support group to being the most important department in the company. Why? It's because during times of change, people crave information. They're looking for something they can hold on to, something that can drive them to a different decision. Well, we're focused right now on planning for the outcome of all this economic change. And what you're going to hear a lot from your internal customers is, I have no idea what to do. They don't know what scenario is going to be correct, which is why you need to plan for multiple scenarios. We cannot plan for a single budget number like we have during times of calmness. We don't need one set of numbers as well. We need multiple sets with a set of actions that says if X situation occurs, Y will be our response. And time is of the essence. We have to be able to generate these new scenarios as information changes in a matter of minutes, not a matter of days. In slow times, we can focus on precision and get things out to 7 decimal points. But in critical times, we need aggregated data and we need it quickly. Luckily, we have the right tools to allow for that quick scenario development. Your internal customers need scenario planning for one very certain reason, and I'm positive of this. The budget numbers for 2020 are going to be wrong. So we have to come up with some additional possible situations that might occur. Somebody was asking the question, this is a screenshot of Oracle EPM. I will save you time. Every single thing you're seeing over the course of the next hour is a screenshot from or a demo of Oracle EPM Enterprise Cloud. So you don't have to worry about what product is this, what product is this. It's just all Oracle EPM Enterprise Cloud, which is why Matt was generous enough to join us because he owns all of these products. So the question is how we get started. Well, there are what I call the 3 rules of scenario planning. First rule, Determine which 2 to 5 scenarios are the most likely to occur. Second rule, take those scenarios and plan for the top, let's say 5 KPIs for those scenarios. Third rule of scenario planning, then use those KPIs to derive the rest of your financial forecast. We don't have time to plan for hundreds of individual line items. Now, once you have those 2 to 5 scenarios planned, you have to take your forecast and you have to share them with the rest of the organization. You have to share them along with an action plan. You can't just say, yep, things look really bad, just wanted to let you know. There has to be some critical step that we're going to take that is going to convert those numbers into physical actions. And those actions should open up a dialogue about how you're going to mitigate the risk of that scenario. So if you look at a scenario and go, this thing seems catastrophic, like that far right one on your screen. By the way, this was a model I made for what if oil prices kept dipping and got as low as $20 a barrel. I changed the name of the company I did it for to Interrel Energy. They at one point, the spot price of oil was negative $37 a barrel. We can go into later on why you can get negative costs for oil. But when we were looking at it, we simply said, if that situation is so bad that we would be insolvent, we have to stop it before we're insolvent. And what companies were doing at the start of March was focusing very much on, oh, we're getting ready to wrap up Q1's numbers. We're looking at our static forecast for this year. It might go up a little, might go down a little, we're pretty sure. And then COVID happened. So I did a survey at the end of March. I asked 114 Fortune 500 companies. The red bars on there are things that FP&A was doing to deal with COVID-19 and the economic impacts from it. The dark red bar, about 5 down, that is scenario planning, creating alternate financial scenarios. Because at that time, at the end of March, everyone realized they didn't know what scenario was going to be right, but they were sure their existing budget numbers were going to be wrong. The number of companies now doing scenario planning, I did this survey again a few weeks later, it's well north of 75%. So if you were in that crowd that is still going, we have to have one budget number, one forecast number, you are in that 25% that's left because everybody else is planning for multiple possible scenarios. One of the first questions I got back in April, and we're getting it even more nowadays, is what should the scenarios be? So if you look at all the analysts for April, May, June, and into July, you could define them into 3 buckets. Basically, some people believed the economy was going to look like this, some believed it was going to look like this, the other ones believed it was going to look like that. What's interesting is time has gone on, people have said, okay, now what scenarios are most likely, and now what scenarios are most likely? It's still these 3. It's just that the time horizons have changed, and everybody has evidence to back up that their idea of what is happening with the economy is correct. Please don't do this. Please don't get so set on one model that you only plan for that one. Plan for the multiple scenarios. And then if you think that one of them is most likely, go ahead and call that your forecast. But please, please have these other scenarios. So if it turns out you're wrong, because it happens once in a while, you're going to have a set of actions in terms of how to deal with that. So I looked at what all the analysts were saying, and I've been surveying and asking everybody since. And these are the 3 major buckets, but all of them have a few things in common. There's going to be an economic downturn followed by an economic increase. It's just a question of how deep and how long does it last. So I took all the scenarios and I averaged them into 3 probable buckets. That red curve is the boy, won't that be nice if it happens, otherwise known as the quick recovery curve. That blue curve is what's called a prolonged recovery. And then we have the blue curve is delayed recovery. The green curve is what's called a prolonged contraction. Now, I'm going to briefly go into economic theory for a second. I will try and make it interesting. The red and blue curves are what are called V-shaped recessions. It's a steep drop for a couple of quarters, followed by a steep increase for a couple of quarters. It's just a question of how deep that V is and how long it takes you to get down and get back up again. The green curve, the prolonged contraction, this is what's called a U-shaped recession. It's a couple of quarters of decrease, a bottoming out for a while, and then a really slow rise, sometimes called a bathtub recession. Notice in that green situation, we don't ever truly recover to the rate that we were on going into what that recession looked like. Now, we have V recessions, as Matt was mentioning earlier. We have these pretty regularly. In our lifetimes, we had one major green prolonged contraction, U-shaped type recession, and that was the financial crisis of 2008, 2009. If you think, well, it sounds like it only lasted 2 years, it actually affected our growth rate for about the next 8 years beyond that. It was substantially curtailed versus the growth rate it was before. We were getting anemic, a couple of % growth. So let's talk about the one that seems the prettiest, the red side of things. This is the quick recovery, and this is the one that a lot of companies were hoping for in March and April. In this quick recovery scenario, the hope was that the developed world would hit our peak of coronavirus cases in May, that there would not be a second wave, at least in the developed world, and the world gets back to spending by the end of June. Now, at this point, some of you are raising your hands and going, Edward, that's insane. Haven't you seen the COVID counts lately? Please realize that if you're coming up with that viewpoint, you're probably in a few specific countries, because most developed countries have actually hit their peak. Doesn't mean there might not be a second wave like we're seeing in cases like maybe Israel and South Korea. But even though our USA numbers are skyrocketing, Europe and Asia, for the most part, have their case counts under control. Africa doesn't seem to at the moment, but they're not a big economic engine like North America, Europe, and Asia actually are. Now, in this scenario, we're looking at a decrease basically through the end of June into July. But then the economy recovers enough in July, August, September that we actually see more revenue in July, August, September than we did in April, May, and June. And by the end of September, we actually have revenue at the same point we did in January of 2020. This is still a possible scenario. If this does happen, which is what a lot of companies are hoping for, they're planning for the worst but hoping for the best. If this does happen, it's about short-term risk mitigation, where we conserve on operating expenses, we focus on stabilizing our supply chain, we plan to come out of this with some immediate resumption of where we were, maybe even stronger. Interestingly, if you go read what some of the analysts are saying, for example, Moody's Analytics says this is their most probable scenario. Right now, most economists and analysts are predicting one of the next two. Jamie Dimon, CEO of JP Morgan Chase, said, I'm sure it's going to be one of these three or potentially two others. He's definitely hedging his bets. A lot of the analysis that goes into this is what is happening has to do with Asia and Europe being past the worst, but also they're seeing good signs in the American economy. USA, our unemployment was 14.7 in April. It went to 13.3 in May. And people went, yeah, that's stimulus money, but June's going to be worse. June was only 11.1. So that is a V-shaped recession where your unemployment gets really steep quickly and then rises back out of it. It didn't obviously rise out at the same rate. We didn't go back to 2.5, but we definitely had the possibility of rising back out of it. So let's talk about the delayed recovery. This is the more realistic scenario. It's the one where most companies are treating as their likely case. So in the delayed recovery scenario, worldwide daily cases of COVID-19 keep growing until late summer in key countries like, I don't know, Brazil, India, the United States. This causes a decrease in consumer spending for 2 quarters. So essentially we drop through September and then we recover over the 4th quarter of this year and the 1st quarter of next year. Now, companies that are planning for this as their most likely scenario are doing some really aggressive strategies to drive revenue. For instance, I got an email from Cinemark yesterday that will let you rent out an entire Cinemark theater and watch about 20 classic movies for $99. An entire theater. And you could just host you and 19 members of your family, and you can have the whole thing. Would have been unheard of, I don't know, any other point in history. So companies are focusing on truly aggressive strategies. At the same time, they have to know what are their least profitable products, the least profitable services, the least profitable locations, and what their least profitable customers are so that they can, at least temporarily, suspend the things costing them money. So in this delayed recovery scenario, layoffs are sadly kind of likely because it's going to take us a year to get back to normal. Prolonged contraction. This is where we don't hit our peak of cases until late in 2020, or it comes in waves as quarantines are enacted and lifted, then have to be reenacted like we're seeing in the US right now. This is a possible financial scenario if it turns out, for instance, there's no clear treatment or vaccine, or if it just becomes a way of life around the world. But notice even in this scenario, we've already hit bottom. This scenario assumes, like the prior one, 2 quarters of decrease, meaning the bottom is now. The bottom is in this quarter, but that our rise will take longer. Now, this is good for companies because they know it's not going to get any worse, and they can start planning, just like the other 2 scenarios, for an economic increase. What is that growth going to look like? Now, this does allow for the possibility that we don't get back to where we were until sometime in 2022. Companies that are planning for this scenario are getting back to the basics. They're saying, hey, in times of great economy, we could leave these underperforming areas. We could keep selling these products that lose money like a sieve, but right now we have to stop doing the things that are costing us money, focus on the things that are profitable. Which products, which services, which locations? What is the 20% of customers that bring us 80% of our profitability? So I'm guessing you are already planning for these 3 scenarios. If you're not, and you have no idea where else to begin here. Plan for these 3 scenarios, and then plan for a series of how you're going to deal with them if these scenarios actually come up. What will be, if it's a really bad scenario, what your actions will be to mitigate that. So this whole concept of planning for, if this occurs, this will be the outcome, has been in place for decades. For instance, you might say, what happens if this new product takes off really well? What happens if this product tanks miserably? So scenario planning is not a new idea, and good companies have been doing it for a while. It's just now become mandatory. We have to be doing it if we're going to survive. And if we plan on surviving more than a couple of years, we have to do this because it's going to be where our profitability is going to come from. So I took another company that we built one of these scenario planning for systems for very, very quickly. Literally, they called us in March and said, can you build one of these things in 30 days? So they called us up, and suffice to say, they're in kind of the chemical space. And when we're looking at their information, we see that our forecast, that's kind of that blue line down there, is coming nowhere near plan. So plan was assuming pretty static, but our numbers were coming in much lower. We just got our June numbers in. We run our normal prepare forecast process. It updates forecasts with the latest actuals. Oh shoot, we were wrong. Turns out the economy did hit us. Now you'll notice that that blue line, that forecast line, did already hit its bottom. It actually went up in May. The reason it was so low in April, our Interrel Chem fertilizer company closed, but we reopened, but we only reopened slightly in May. Notice we actually see some really decent numbers in June and back in July, but we're still not up to the levels we predicted. And that is only assuming that our forecast is a true quick recovery. What if that's not true? What if the July numbers actually come in and we see we're actually on a delayed recovery path? Well, that's the yellowish line, that kind of orangish red at the bottom as a prolonged contraction. It looks bad all the way into 2021. What we should have done is built this system already and adjusted our expenses back in April, May, and June. Because if you look at where we were trending, we did a slight correction, but we actually still spend money like we had previously planned to, because that's what we'd forecast. So we spent it to that level. We should have done cost-cutting measures in April, May, and June, but we didn't, and that shows in our actuals. It shows that our expenses have remained in line with our forecast. But what we actually want to do is, if we go drill into it, I'm going to go look at my income statement. That's my lines down below. That green line, that's that forecast line. There's my delayed recovery. If I go over here to the side, and I'm just going to hit maximize. This is easier to see for all of you. So there's that plan number. Awesome. I planned $228 million in product revenue. Year to date, I'm at negative 36 million. So I planned on 78 million in net income. What I'm actually getting at the moment is closer to 12 to 13 million, which has caused me to be short of plan by $35 million at this point. So why? Revenue didn't drop as much, but my net income tanked. It's because my expenses stayed too high in April, May, and June. So what this tells me is the recovery is going to take longer than I expected. Now I need to go do something for July. Now, there are pre-built dashboards throughout Oracle EPM, and I'll get to visualization in a second. But the next thing I need to do is just check on my cash flow. Am I about to hit zero, in which case I probably should stop analyzing and either go make some big changes or update my resume. But in my case, we still have cash. We thought we were going to be at 7.2 million in net cash flow. Somehow we're still positive through various other financing and other things that we've done. We're still at 2.9. But is it really going to look this good? Because this cash flow forecast is probably going to be inaccurate. So what I'm going to do is I'm going to go off and go create another scenario. So there's my prolonged contraction scenario that I have. And I'm going to make a version of that scenario, because once you have, okay, we're going to do this prolonged contraction, I need to start asking myself, how can I deal with it? Maybe there's a layoff mitigation strategy. Maybe there's a reduce our product strategy. There might be a let's expand and go collect market share while everybody else is suffering. So it's not enough just to do scenarios. I have to do versions within those scenarios that I can then go plan for and compare. And this is where I get into the actions that I'm actually going to take. It's really simple to do this if you have a good planning system. You just simply take whatever that forecast was you started with, you copy it over to this placeholder scenario, whatever you're going to call it. You start applying some big picture assumptions. What I think is going to happen with our company growth rate or declining rate, what's going to happen with our expenses, increase or decrease. You start analyzing it, and then you've got to get to those mitigation plans. I've got to figure out what I'm going to do with this information. So in my case, I think the most likely one is probably going to be the delayed recovery. So I'm going to leave prolonged contraction out there right now. So I'm going to hit my copy, and I'm going to say, in terms of copying it, I'm going to go out. There's my delayed recovery. So I'm going to copy my forecast into my delayed recovery, and I'm going to copy it into my working scenario. Once I get one I like, I'm going to copy it into other versions. And I don't have time to go through a rebudget process. This is where scenario planning says focus on a high level. So I'm going to focus on a few key drivers. I think I don't even have to type in what the overall driver is going to be. I can talk about a change in my driver. So I think my volumes for Q2 and Q3 are going to go down by 50%. I think my labor, I'm going to be able to do some strong actions. I think that's going to drop by 10%. Now notice I've got a few other ones out there. I could actually go affect the rest of 2021 or all the way to 2021 if I wanted to, but instead I'm going to click save. I thought that was going to take longer. It ran in like 4 seconds. When it comes back, I now have an additional scenario. So my delayed recovery says, okay, my blue was what my forecast was going to be. My green actually thought I was going to do higher. My orange is my more realistic. This is my actual delayed recovery scenario. Now I do have the ability, if I wanted to go back and do a prolonged contraction. I could get all the way out of this 2021, but I need to go look at the impact. So I'm going to go out to my financials. I'm going to pull up what my revenue looks like. I'm going to drive into this a little bit. I'm still looking at my forecast scenario, otherwise known as the very unrealistic one. So I'm going to look at my delayed recovery at this point. Those are my key drivers. So you can see that I started with a $484,000 volume, and I predicted an adjustment downward. Right now, that adjustment is all out in Q4. If I wanted to, I could decrease it elsewhere. And this is where we're getting into the 5 to 10 things that drive 98% of what my forecast looks like. And I can drop it by a whole dollar. I can drop it by a percentage all the way across. And then just like before, when I've got the numbers where I think I'm ready to go out and save it, I'll commit it. It's actually behind the scenes deriving the entire rest of that forecast. So I can go out and say, well, what has it done to my overhead costs? And some of these I can just flat out reduce. I can say, well, we're going to furlough people in the month of July because we have to get this under control. And I can do it at a granular level. In my case, I'm at Texas and ammonia. I could do it at a much higher level. The key is speed. The key is not accuracy. Notice I'm not doing $25,419.17. Once I've done these big picture changes, I can say, well, how has this actually affected my whole expense model? And I could, if I wanted to, and I'll get to that in a second, actually allocate this all the way down to a detailed expense level. Or I could get into that second tier of adjustments. Things like, what would happen if I changed my travel budget to 0? Because frankly, people should not be staying at hotels, especially without masks at this point. And I can see what that overall net income impact would look like. Once I'm done making my changes, this is a cash flow trend. I need to verify that there's not a case where the number drops into the yellow zone. This is the bad situation because this is where cash goes negative and I'm just bleeding money out. Well, as you can see, there are various periods where that actually happens. Some of you eagle-eyed people amongst there have looked over to the right and see that it's because I'm still doing a lot of repayments. I'm still doing a lot of stock buybacks. Probably not a really, really good idea because it's actually probably going to be worse than this. I'm probably going to be in a situation where people are delaying their payments to me, but I can also do the same thing. rather than just wait for all my customers to say, yep, we were paying you in a day sales outstanding of 30, we're now paying you in 50. I can assume that it's going to slow down. I'm only going to get 25% within 30 days. But I can also assume the other side, that when I'm actually making purchases, that I'm going to delay what those look like. So I can run different scenarios. What if my day of sales outstanding goes from 30, or what if it goes to 45, or what if it goes to 90? And I can see down below, that's the impact of what my cash actually is. So it's still dipping down beneath into that kind of below zero type level, but there are fewer dips than we did previously. What I probably want to do is immediately stop the stop buybacks. So head out there into September and say, yeah, we probably should be doing common stock repurchasing right now. That is a big $10 million bump. So let's go out to October or September and back that purchase actually off. Once I do so, it gets rid of that major dip. I don't know if you saw it, but there was a major dip out there that occurred in the September timeframe. So as soon as I go off and run it, it'll take approximately 4 seconds. I'm doing this in real time because that's great fun. Let's do it for, there's my delayed recovery, and run. 1,000, 2,000, okay, 2 seconds. When it comes back, it takes that impact, moves it all the way out. And then if I jump back and say, now what does that cash flow impact look like? You see that that September dip is a lot less than it was, to the point of $10 million farther out. So that's kind of general of scenario planning. How does this apply to a specific industry? Well, I'm going to use retail as an example. And I was trying to find a retail example where it's not as bad as it could be. So the example I went with was, what if we were a wholesale hardware store? So imagine we're a big box company. We are the next Lowe's and Home Depot. So going into 2020, we thought it'd be a great idea to launch a retail company. And boy, did we have no idea that COVID was coming. But similar concept. So I'm going to go up to my creatively called Recession card. By the way, I customized it. There's not a default Recession card in Oracle EPM Cloud Planning. Now, I assume my business is, while it did dip, it's actually starting to pick back up. So I'm going to look at IRC warehouse. I could go to corporate, but I'm just going to look at Dallas right now. So I'm going to plan for the next couple of years, and I'm going to do my forecast. I'm going to look at my plan. I'm going to look at my delayed recovery. I'm going to look at my prolonged contraction. I can switch to different product categories. I can say, well, are people doing electrical projects right now? Well, maybe not. They're doing a lot of plumbing projects where they're doing it themselves. And wow, if we went all the way over to where people are actually building gardens out front, you know, those areas are skyrocketing. So in terms of doing their own plumbing, if I actually look at average sales per customer, this is actually doing pretty well. In terms of profitability, my revenue is actually increasing. I have more people either going to my stores or actually buying things online right now. I can look back at total revenue, and I can say, yeah, the prolonged contraction actually isn't that bad. I'm actually looking at 1.5 billion in projected revenue going out there. I could, if I wanted to, look at same store sales though. That is not looking very good. That's really the net difference amongst my stores that are out there. And I could drill into specific months if I wanted. What I really have to do is go take some action. Now, the recession one I created just for the benefit of you all seeing it. You can also use what's built right out of the box, or use what's right out of the box. So I can go to the financial section, go into operating income, can jump already to the operating income dashboard. I can pull up that driver-based form, and this is literally straight out of the box, just with my entities loaded and my data loaded. I'm going to take some calculated drivers. I'm going to make some assumptions about what my returns or my bad debt, my contract labor might actually look like. And they could be a decrease or they could be an increase. Like I might say, there are fewer people probably that are going to come into my stores. So I was assuming a bigger number, but people don't want to come back in to return something they're slightly unhappy with. So I could decrease it across the board, or I could decrease it maybe just specifically in electrical. I can spread it all the way back across. I can jump over and say, what does that impact my dollars? I can also just make a lot of high-level changes where I can just simply say, my overhead expense is too high, and I need to really control costs going forward. So I can do those high-level top changes. Now, for those of you that haven't seen Oracle EPM before, the first thing a lot of people think is, well, wait a second, I'm doing this in Excel. I want to keep doing it in Excel. literally everything I've shown you, you can do in Excel. So if I want to pull up the form and say, yep, I really want to adjust my order pickup sales, and I think that people are much more likely to do pickups than they are to do in-store, or they're much more likely to do online versus actually going into an overall store location, I can submit that and see those impacts just as well. It doesn't matter where you're doing scenario planning as long as you're just doing some level of scenario planning. I'm not going to go into it heavily in detail because we only have about 20 more minutes, but from the standpoint of ad hoc, this is your lifesaver right now, because we've got to get into a world where we get people out of looking at static income statements, because those were designed in a period of stability. Right now, we are in a period of unknowable change. It might be increasing, it might be staying the same, it might be decreasing. This is really where we need the power of the drag and drop to be able to just zoom into the things that we find interesting. But the second tool we really need to focus on, once we've got our scenario planning underway, is strategic modeling. Strategic modeling helps companies figure out what their constraints are. When are they going to violate their debt covenants? When are they going to use up their available cash? When are they going to need greater capital lending? What they're really trying to do is figure out, what are our financial constraints? Recessions can occur at any point, but economic upturns can as well. Strategic modeling lets you put together all those several different scenarios and model all those possible outcomes. So right now, everything we're seeing says the economy is actually trending up. It's getting better. Is that going to be true long term? So we need to take that revenue, take those expense projections, and say, what happens if it keeps trending up? How will we take advantage of this? Strategic modeling focuses far less on the details and rolling this out to as many people as possible. Strategic modeling is really focused on the big picture. How can I quickly get into a model and say, what would the increase look like? What would the decrease look like? Go build me something out of the box. Oh, for anybody that doesn't know, if you're thinking, yeah, I actually own part of Oracle. I own, maybe for instance, own PBCS. Oracle, and thank you, Matt Bradley, for doing this. Oracle did something that I consider a remarkable, solid, and maybe unheard of in the history of Oracle. They gave away something for free. If you actually have PBCS, the old Planning and Budgeting Cloud Services product, you actually don't historically have access to strategic modeling. You have to be on Oracle EPM to have access to it. Oracle actually has given that to everybody through April of next year. So even if you are back still on just PBCS and you're looking at this going, God, I wish I could have it, but I can't, you can through the end of April next year. So this will let you do modeling during that critical time period. So thank you to Oracle and whoever went up with the change and approved it. I think it's absolutely awesome, because what it does is it lets you companies that have Oracle EPM Enterprise, if you don't, go buy it, or if you have PBCS, you can now just get in there and quickly say, okay, let me do a 3-year model. And I want to plan 2020 and 2021 down to the month level, maybe 2022 and beyond. I want to leave it a total year level. I want to go off and I want to create a new scenario, and it actually gives you a standard set of income statement accounts, balance sheet accounts, cash flow accounts to look at. It lets you quickly come up with new versions of those scenarios. For instance, maybe I want to take my traditional case and come up with a best case. What if things really, really looked good? What if we didn't end up in a delayed recovery or prolonged contraction, but it was actually a super fast recovery, what that would look like? Then I want to take and compare all those across, and I want to do it over the web. Maybe I want to do it out in Excel. I want to inherit those numbers downward so that I don't have to recreate what those scenarios look like. I want to take that base case, I want to start making adjustments to it, and then I want it to populate an income statement, and I want all that pre-built out of the box. Now, it will give you not only a best case and an expected case, it will give you a worst case. So this is the one where all the numbers start turning red. This is important because it tells me, okay, if these drivers actually happen, this is what will occur if nothing actually changes. Because a lot of people hope that things will change, but they have no logical basis for it. One of the nice things about strategic modeling is it doesn't have that bias that the humans do. It actually is using a combination of Monte Carlo simulations, artificial intelligence, a bit of machine learning, and a whole lot of financial intelligence to come up with, these are the most likely set of scenarios that you're going to run into, and then you can start changing them. So it'll get you maybe into the situation of, okay, I think we're profitable. Could we be more profitable? Or at the moment we're unprofitable, how do we get back to profitability? The key for that is our third tool. Companies, once they've done imagining and planning out what their scenarios look like, coming up with that strategic model, maybe they might look at it and say, I need to go improve this. What do they do to improve it? you've got to focus on profitability and costs. My advice to every one of my customers is do not wait on this one. Far too many companies wait until they end up in bankruptcy court to figure out which products and stores they should close, or locations or facilities, or which people they should focus on. You have right now today, I'm absolutely positive, unless you are in a couple of very specific industries like movie theaters, you have products, you have services, you have locations, you have customers that are making you money. You have to figure out which of those products need to be stopped, which of those locations need to be closed. What are the 20% of your customers that are costing you 80% of your profitability, so that you can focus on those 80%. You have to figure out what those unprofitable money drains are, and you have to stop doing them while you have liquidity. Well, there's an amazing tool that answers questions like, what are my most profitable and what are my least profitable products and locations? So I won't go into it in detail, but I will tell you a completely true story. I got a call from Kmart a number of years ago. If you don't know what that is, ask somebody under 40 or over 40. I got a call from Kmart shortly after they entered bankruptcy. This is before Sears bought them. And they said, we want to use Oracle EPM. At the time, it was called Hyperion Profitability and Cost Management, but we want to use Oracle EPM. We want to use it to figure out which of our stores we should shut down because we're going bankrupt. I asked them, why didn't you do this before you went into bankruptcy? And their answer was, because we didn't have the money. You need to do this now because cash is king. We have to figure out in the next 30 days, that's about how long it takes to implement this, figure out in the next 30 days what products are costing you money, which facilities are expendable, which people aren't pulling their whole weight. We have to take those high-level costs and we have to allocate them down by product, by location, by customer, whatever, and then we have to take action. If you remember one thing about this hour, don't be Kmart. Don't implement a profitability solution in bankruptcy court. One of the things that I do like is it really lets you drill into your profitability so that you don't have to just say, yep, this is losing me money, but how much money are they losing? Well, there's a curve called, sometimes called a whale curve. Some people call it a profit curve. And it focuses on what are the customers or locations or products that are making me money. Then eventually they will plateau. Then I get to that point where I'm actually losing money. So right now, 60% of my customers make me money, but 40% are actually losing me money. And I can pick how I want to drill down. Do I want to look by region? Do I want to look by sales rep? Do I want to look by product? And I can say, do I want to look at the high level? Maybe who are the top 20% of my sales reps or regions, or the top 10%? Or I can flip it around and say, well, what's at the bottom? What's truly costing me money so I can figure out where I need to go cut this? Well, if you look at it, 2 regions are resulting in 10% of my profit loss. 44 customers in the Southeast cost more money than if we didn't have them at all. This only works if you're going to translate it. By the way, I apologize for whoever Noella Dykema is. This is randomized data that I put in here. Noella is actually a truly awesome person. I've always liked Noella. But right now, Noella's customers are taking away 16.77% of the overall company's profitability. Literally, if Noella had sold to no customers whatsoever, we would be 16.7% more profitable. Now, what I've discovered is if you go tell somebody that and show them, look, your customer is unprofitable, your department is unprofitable, the very first thing they will do is tell you your numbers are wrong. And they will argue with it because it's a black box that got some big number allocated. Yep, you told me I lost 93 million. How did I lose 93 million? Profitability actually lets you drill into it and say, well, it got allocated from here, here, and here. And this is the driver that it did. And based on your head count, or the number of customers you did, or the number of units you sold, or the number of facilities you had open, or the square footage in your department, we can track it all the way back to where that initial number actually came in and figure out how it was contributed. So it's not a black box, but rather a visual tree, a hierarchy of how they ended up at that information. And this is key because it's hard to look at a grid. It's definitely hard to look at a final allocated number and told you are an unprofitable person or this is an unprofitable facility. It's because it's a static bit of information. It's data with no context. So what we have to do is we have to take that information, we have to visualize it. Just like I showed you how you could visually track back to see where those numbers were allocated, this is the key as number is changing constantly. We have to have visualizations that give us that big picture view of our KPIs and give them to us in real time. We have to make sure that we are absorbing information as it's coming in. This economic situation is changing too rapidly. While it looks like we're on the upswing, we have a whole lot of uncertainty to plan for. We have to make sure as the quarter, as the quarters are happening, what is going on with my business? Not once the quarter closes and I get halfway into the next quarter, what happened? Because it's too late to do anything about it at that point. We have to go and dig in and ask deeper questions, take physical actions now. Now, I showed you some examples earlier of built-in dashboards that actually come with the system. That's how most people use Oracle EPM, is they're looking at those dashboards as kind of heads-up displays of their financials. They're also super easy to create. This is not like, you know, trying to dive into a, I don't know, like a Power BI or something like that. You actually take kind of those default forms, those default interface, and just sort of reposition them and drill into them. That one on the right, I wanted to show you what would it take if I went and decided to build a quick little dashboard to analyze my new hardware company. That one on the right took me 6 minutes. I'm not exaggerating. Start to finish, 6 minutes. And now I have something that can let me analyze sales in real time. So as data is coming in, what does that impact actually look like? Another quick way to make visualizations through Oracle EPM is something, I don't know why people don't use this more often. I absolutely love it. It's a feature called infolets. These are simple little visualizations that you can create quickly, and then you can sprinkle them wherever you need it inside of EPM. It's got a simple little drag and drop interface, literally takes minutes to learn. You can use these to show small bits of information on a dashboard. You can also use them to show information as the process goes along. So for instance, rather than just see a set of steps, do all these steps and your books close. Imagine step 4 is, okay, now here's how my cash flow looks. Step 8, now here's how my cash flow looks. So it becomes part of that budget process, becomes part of the close process. So a step right there in your list of tasks is actually, how does that number, how is it actually changing? What is the impact going to look like? Building these infolets, literally it's minutes and not days, because when the economy is changing this rapidly, suffice to say, we don't have days. Once we have all this information, we have to have a conversation about it. Far too often, people in FP&A think their job ends when they hand somebody a report. It doesn't. That's the day our job begins. This concept of giving context to a number, opening up a conversation, opening up a dialogue, the industry term for that is called narrative reporting. And people think that narrative reporting should only be used after the fact. Like, oh, we do narrative reporting. We use it to explain why budget and forecasts were off from actuals. My advice on narrative reporting, use it ahead of time. Use it to communicate these new scenarios that you just planned. So before, I don't know if you saw on that very first screen, I was showing, here's how my delayed recovery scenario compared to what I actually forecast. That is a forward-looking conversation. Far too many companies wait until it actually happened and then have a conversation about what already occurred. Trust me, Back to the Future was not a realistic movie. You cannot go back in time and get hit on by your mother and change history. It doesn't occur. History is fixed. We have to give context to those numbers in real time. This is the tool that helps you actually do that. If you don't use the term narrative reporting at your company, I don't care what you call it. You might be calling it give context to your data. Some companies call it explaining why our numbers are off. Variance analysis is the most common place that narrative reporting shows up, mostly because it lets companies have a constructive dialogue about why your budgets are changing, why they were off from actuals. There are a whole lot of other usages. You can prepare books of reports. You can distribute packages of information. Whatever you're doing, the goal is to open up that dialogue ahead of time about your numbers. So when you hear narrative reporting, I want you to think unjamming the lines of communication so that I can have constructive conversations about why my numbers are off and constructive conversations about what we're going to do about it. Also use this to report out to the street. There are customers that I've heard of today, Uber, Netflix, Gap. Their narrative to the street was, we know our prior guidance was incorrect, so please follow our guidance. Our new guidance is ignore our prior guidance. And that's all they're telling it. Those type of answers make Wall Street really jittery. Wall Street does not like uncertainty. They have to take whatever your company is expected to be worth, and they have to drop you by however much you're not telling them. So whatever your peak could be, the more uncertainty they have, the more they have to assume possible worst case. That's just how investors work. The absence of additional information, assume the worst. So this is an example of narrative reporting. If you haven't seen it, I went and quickly created a report on top of a manufacturing company. I changed all the names to IRC Manufacturing. I'm calling this my uncertainty plan. All those tables, all those graphs you see are real time. They're actually generating right off my numbers the moment I pulled up this report. Now you'll notice there key questions that I was asking. Those key questions were not embedded into the report package. It was actually a conversation that I had where people receive this, right? I'm going to be Ralph. I've always wanted to be Ralph, ever since I saw Christmas Story. So Ralphie logs in and he gets notified, hey, it's time to go back and look at that report package. Now, at this point, it's not static. It's not like you're handing someone an income statement. I can go in and I can comment, and it'll actually be attached to that row or column or cell or grid or page, wherever it is I have a question about. So I might, for instance, I'm looking at that and like, why is, in the delayed recovery scenario, why is my material unit cost so darn low? And I can ask that, and it'll collect it all in one common place. I don't need to go offline and shoot an email. I don't need to stand up on top of a cubicle because we don't have cubicles anymore. So I'm going to say, why is my material cost so low? At this point, somebody else can log in. Let's see, I've always wanted to be, I've always been a guy my whole life, so I'm going to go off and be Laura for the moment. I've heard Laura is an awesome name. So I'm going to log out. I'm going to log back in as Laura. Password is password, don't tell anybody. Oh, look, I have a message. That's because Bob just commented. There's that report. It's under review. Click on it. There's Bob from Interrel. Go down to that first comment. Why is our material cost so low? So I can say, we gave 70% off all of our products during the month of August, and that's our logic. Now, once I save this out, Ralphie can log back in and see Laura's immediate response. He can accept her reason. He can complete the review phase. He could have a conversation back and forth with her. All these comments can be attached. They can be sent out as footnotes, but it gets me out of the world of assuming that reports are one way, that information is only delivered outward. So to bring this all together, you and your internal customers need information now more than ever because they want to make better business decisions faster. They need scenario planning to help plan for possible scenarios, strategic modeling to figure out how to stay within their constraints, PCM to know what areas are making money and what areas are losing money, data visualization and real-time analytics to see data as it comes in so they can take action now. And finally, they need narrative reporting to have a better conversation about their numbers. Now, what we're talking about right now is short term. Get these things as the economy is pivoting from heading downward in that V to heading upward in that V. These are even more valuable if you keep using them long term. Don't treat this as a one-off, like I'm doing it right now because the economy is changing, and then all of a sudden I don't care about profitability or care about conversing about my numbers, care about visualizing my data. These become more profitable long term. Now, I know that it's hard to find news that's relevant to all of you in what's happening in the current world, what's happening in finance, planning, analysis. We have created our own news site. This is entirely free. You don't even have to register. Go to interworld.com/updates, bookmark it, update it periodically, and you'll see the things we think are relevant that are affecting the world of finance, planning, analysis, consolidation. There's even a mobile version. If you just want to bookmark it on your phone and go look at it, you have the ability to upvote and downvote articles. If you decide to give it your email address, what will happen is each time there's a series of news stories that got highly voted, it'll email you what the stories are. That's literally all it does. So I'm not doing this for any monetary gain whatsoever. If you think I'm going to make up free news in volume, I'm not. I'm trying to just be an aggregator and distribute a lot of information out to you in the world. So some of the stories that I have featured recently have to do with people interested in scenario planning and some things they're doing. I had a story on talking about zero-based budgeting, how that's affecting the world. We also have some good economic news because it's impactful to your scenario planning. And if it's bad, I'll let you know that. If it's good, I'll let you know that. But it is very specific to how is it going to affect your company. So some of the news that I've seen recently, RV sales and rentals are actually up. If you look at that red and blue line, that's Thor and Winnebago, two major RV companies. They were actually doing much, much worse than the overall stock market, the S&P, because nobody wanted to spend money on a brand new RV. They're now doing much better than the S&P 500 year to date. And it's because people are looking for a safe way to get out of the house and travel. They are spending money on bigger purchases. Home sales are actually up. In terms of going down, going back up, people do need to move. Believe it or not, during times of economic downturn, people that have money will spend it on a house if it gets them somewhere where they view the economy is actually doing better. Also, massively low interest rates. Some people say, yeah, if I'm gonna be staying at home, I need a bigger house, or I'm gonna stay at home and I need a bigger home office or a place to work. So we'll also see it, home sales increasing right now. Unemployment rate down. Like I said, we had our worst back in April at 14.7, and it's now down to 11.1. So take that unemployment chart on the left and invert it, and you have a V-shaped recession. Even industries that I thought might never make it out, oil and gas, we are driving again. Cars are driving again. You might look at that and go, wait, people are driving again? Isn't that a bad thing? Doesn't that kill the planet? Yes, bad for the environment, good for the economy. Factories are operating, people are spending, we're driving cars, businesses are driving trucks again around the world. It even shows in the price of oil. West Texas Intermediate actually briefly went to negative 37. Really, it bottomed out at about 10. That's the best V-shaped graph you will see all year. That is truly down and back up at about the same type of rate. Some of you are wondering, can I take this and actually make it happen at my company? I'm not trying to sell you anything. I literally had not a single slide on who is Interrel or what does Interrel do. If you're interested, please email me. I'm happy to talk to you about Interrel. There is one thing that I will strongly advise. If you are not doing all these things right now, please let me help you out. Go to epm.bi/VSA. VSA stands for Virtual Strategic Assessment. epm.bi/VSA. Over the course of 3 days, I can help you figure out what you should be doing with planning, what the outside world is doing with financial close, what are best practices in reporting and analysis, how to get this in place really, really fast and get it approved. I know that was a ton of information over the last hour. I want to thank all of you for joining me. I want to thank Matt Bradley for taking the time out to tell us what he's seeing in the outside world. My name is Edward Roski. I hope you will take this information to heart, that you'll use it to manage the economy now and thrive in the future. If you remember just one thing, take this away. Every single thing I told you can be implemented in not 6 to 8 months, can be implemented in 6 to 8 weeks. So that's a ton of stuff. You might go, that's multi-years. It's not. You are talking weeks to actually make something like this happen. Thank you, everybody. Stay safe out there.